Welcome. Thank you for joining us this afternoon as we recap the April WASDE. It is April, right? Yeah. Maybe more exciting than the intentions and the end of the month March report, believe it or not. Few changes in the works here. We're going to go through the balance sheet. Got Brian and Jeremy joining me today, so let's get into it. Positive board reaction. Corn, as I was walking away, up 7 or 8 on old crop, couple cents on new crop. Beans, double digits on old crop of about 15. New was up just light of a dime. Wheat mixed, down across all classes, 5 on SRW, 10 to 12 on HRW, and just under a dime on spring wheat. So, Ryan, what are we seeing that caused that? First, in the corn balance sheet, we saw some shakeups between exports, maybe not quite the reduction we were expecting in feed residual. How did it play out? What are we looking at on the numbers?
Yeah, I think you hit the nail on the head, Nate. The export picture is something we've talked about all winter, how the U.S. is primarily the only shop in town. And we continue to see good export weekly sales. Now, they're going to eventually slow down here. They have to, or blow by even the updated USDA forecast. But the USDA did catch up, as you said, 100 million bushel higher on the export forecast for old crop. I think that the feed residual number is still a question mark, Nate.
Yeah.
But the bottom line is we'll probably live with this number now for the next 3 months until the end of June. When we get the next stocks report.
Yeah. Good point.
The one caveat to that would be the wheat corn spread is tugging in, is narrowing in, Nate, as we speak. You look at the July in Chicago, for example, for wheat, and the July in Chicago for corn. That thing is really narrowed in, Nate. And I think that's something that the trade will be watching, if nothing else. Whether the USDA adopts any changes, that's a whole other issue. But for the time being, I think we're worth that feed residual number for the USDA, at least for another month or two. And that means that they're under a 1.5 carryout now for old crop corn. That's not running out of corn, but it's also not a 2 billion bushels what we were looking at last fall.
Right.
When we talked about 24, 25. So obviously the corn market responded the day of the upside.
Right. Yeah. A 1.465 carryout with 100 up in exports and just that 25 cut and feed residual. Some of the trade maybe was more than the expectation of 75 to 100. Right. We've seen and noted on these conversations, we've seen those cuts in the Milo domestic use. Didn't make any changes today, but going back to Jan and Feb, where we reduced the Milo exports, put it into the domestic use. Partial offset with that today in the corn, but maybe not quite the expectations. And to your point, what's becoming maybe a more comfortable wheat balance sheet, we still got a lot of growing season yet, but tightening that corn carry out and watching the Brazil production, just to note, and we'll get into the numbers, but we had CONAB today, and I think they were up just under 2 million metric ton on their corn production. And right now, the USDA CONAB spread on the Brazil production is only about 1 million metric ton.
That's right.
Last year, that was somewhere between 11, 13.
Really
I think it was double digits. So maybe we're a little more comfortable with it. We're still watching some key weather for Brazil, obviously, across this stretch of April, with some scattered showers and maybe a few more timely rains coming to ease that concern a little bit. But still just that available stocks, as we've seen their increase in domestic use from the USDA the last couple. I think they left that unchanged today, but they made some pretty big jumps. Maybe the last couple WASDEs increase in the South American domestic use on corn. So we're seeing a basis environment, a cash environment that's, I think you framed it up. It's tightening corn carry out. That acre number for new crop could give us some comfort, but we got to get that crop in the ground yet. So anything really on the world side that stands out, or maybe kind of shifting to the U.S. planting window here? Some heavy rainfall in the southeast, Delta, mid-south area over the last week. Going to take them out for a little bit. We had some scattered showers across the central belt, but I think we're opening up here probably in the next 7 to 10 days, maybe get some field work done. You hearing anything, Jeremy?
Oh, I think guys will be trying to roll early next week through central Illinois. Southern Illinois is a little bit more wet. Forecast does look sunny, windy, warm.
Help dry it out, yeah.
Yeah, I think
little warm temp would be welcomed.
Yeah, guys can go in a hurry. Once
Right.
they get going, we can get this whole crop in the ground in a week.
Good point. Good point. That's kind of where we're going to shift our focus now that this report's behind us. But anything on the world balance sheet on corn, Brian, that stood out? Or
I think just reemphasizing what you just mentioned a moment ago, Nate, in Brazil, they're not going to be harvesting that crop even if it's a 125, 126, 127, whatever, which would be the second largest crop ever, Nate, they won't be harvesting that until July at the earliest. And then you're talking about a little bit of a turnaround time. The very earliest we would look for those exports to work their way into the world pipeline would probably be late July. So the bottom line is, yes, they are positioned today with the weather improving to have a big crop, but they're still, number one, it's not in the bin yet. For the next 30 days, it could still change from that number. But even if it is a big crop, what you mentioned a moment ago is important. Their domestic usage continues to rise. So maybe their export forecast for next year is eventually going to possibly be trimmed back a bit. Bottom line, U.S. is well positioned, Nate, in the export market for the next 3 months. Definitely. I would stretch that into 4 months.
Yeah, sure feels like
primary shop in town. There's some Argentine supplies that are going to come online here fairly soon. But bottom line, the export forecast at 255 feels really good today. Going forward, as you said, farmers are going to hit the fields now. You and Jeremy both hit that. So any remaining old crop, is probably going to be a secondary thought here, unless we get a flat price rally continues to charge higher here. So all that being said, you said a very good thing to remember for new crop. That 95, 96 million acres is lurking out there. And I think it could be that high if we can get the weather to clear up here with the wheat corn, or beg your pardon, with the corn bean corn ratio where it is. It's still favoring corn for 25 here, Nate.
Absolutely. And you made a point there on the export picture. I know there's a little difference in the crop year, I believe, when we look at the CONAB versus USDA, but there's a 10 million metric ton spread between their export forecast for Brazil. And apologize, I don't know. I do think some of that's due to the crop year, what CONAB looks at versus the USDA, but it still points to your, the final comment is probably a little bit friendly corn here for a little bit until we're starting to feel more comfortable with that U.S. outlook. They didn't adjust the flat price estimate on the corn picture, right? The sub 10%, 9.6% stocks to use suggest, on a regression model would be probably above a $5 corn board. So we don't like to, we want to use options. We don't want to say we got to go there. There's still a bunch of noise with tariffs and the port fee structure and how that could impact our flow. But U.S. is the supplier of corn. That holds. We're seeing that reflected, I think, in the flat price move and the basis environment. And as of the last couple, probably last week and a half, the spread environment, we've seen that May, July corn spread come in from 8, 9, 10 on the lows, and now it's back into 4 or 5 cents. So market's painting a pretty clear picture that there's some front end corn demand here. And farmers, I think, should be looking at taking advantage of these rallies on the remainder of old crop, especially if they're going to start focusing on planting, and probably need to shift a little bit of that focus to marketing some new crop and get that old crop taken care of.
Oh, without a doubt. Looking at the old crop corn, right now your May July spread is around 6 cents. Interest is around 4.5 to 5 cents during that time frame. There is no real carry in this market. It's time to get rid of that old crop and look at buying a call. As Nate said, there's plenty of reason to hope for higher prices.
Sure.
We cannot guarantee it. And the tariff talk could send us down substantially or could send us up substantially, as well as in the growing season and the crop size. But calls are reasonably priced. A July at the money 4.90 call has a value of 18.5 cents. That gives you unlimited upside right in the money, but more importantly, it gives you that floor in case things fall out of bed.
Sell that cash, buy that call, get you through the U.S. planting season. If there's any dryness or any delays or concerns, you're able to take advantage of that.
Exactly. And talk to your local advisor on the basis. Right through here, it makes the most sense to get it locked in for June delivery if it's on farm, but every market is different. I can't pretend to know what's going to happen in the Western Belt, but yeah, talk to your local guys out there and see if that makes sense as well.
Good stuff. Good stuff. Jeremy, shifting to the beans a little bit here. You want to run us through any of the changes from the WASDE, global or U.S.? Just kind of quick rundown. Not as many changes, kind of as expected. I
Not
think,
as exciting as corn. The net change in carryout was lower at 5 million bushel. Imports up 5 million. Residual down. Down 3.
Yeah, slight reduction.
Yeah.
Seed down, residual.
I'm sorry, seed down 3, residual up, and a crush up 10. So a net change down 5. the market is going to shrug that off and really start to focus on the tariff talk with China. China is going to be the number one talking point in the market here until it's resolved, probably.
That could be a pretty big swing.
It could be. I talked to Dr. Schonkweiler before I came in here. He said it could be 200 to 250 million bushel swing in exports for new crop.
Yeah, talk about volatility in the bean
Absolutely.
market, and screams optionality to me for a producer.
We're talking dollars up or down from here potentially based on how the outcome of these tariffs come. So we were talking right before we jumped on here. Obviously, old crop, there's not much carry. Let's get it sold. Buy calls in case it is bullish. But more importantly, new crop, we're not quite at break evens, but we could be substantially below if these tariffs are enacted and we don't ship anything to China. We can buy a $10 short dated July put for 29 cents as of the close right now. I think that $10 just is a great spot to get in.
It's a magic
having
number.
that floor. You get through the end of June, and one thing we've learned from this administration is, and they move fast. There's going to be a lot happening between now and expiration at the end of June. So that gets us through a lot of unknowns, as well as more Brazilian harvest news coming out. And that's right.
Right. And USDA didn't make any changes on the South American bean production. 169 still for Brazil, still a narrow gap with CONAB. I think they were a 167. Yeah, just under 168. So feels like, as we've mentioned on these conversations, feels like that Brazil crop harvest has progressed, ample global supplies, but this dynamic of, is China and the U.S. going to have a trade agreement? The escalation on the front here, 104%, 200% tariffs. I mean, it's laughable almost when you talk to it in the cash market. I mean, Brazil basis could go up $10 and they've got a captive market. Now we're seeing some, non-Chinese buying, a little bit more interest in the old crop picture here, and it can be supportive, but I think psychologically, just as I look at marketing my own bushels, as potentially friendly as an 83.5 bean acre number could be, and how that could swing with a trade agreement if this pace of tariffs ultimately comes at a quicker resolution. I think some of the risk is that could be post-planting, right? We're not rallying the board, as you mentioned, Brian, in the bean corn ratio to really try to buy those bean acres. So as a producer going to say, your guess is as good as mine on Trump and China and what the resolution or continued conflict could be. So again, it just screams volatility. Don't get too caught up in what a ending stocks number on a new crop bean balance sheet could be with those lower acres. But to your point, Jeremy, I mean, this isn't 30, 50 cent moves. We could be extremely tight. We could have a captive agreement like we saw in 20, where China's buying a lot of U.S. beans. Somebody around the world is going to realize the supply out of Brazil. So we may, there could be some offsets in there, but I just think the idea of a trade agreement, that could bring huge moves on the bean balance or on the bean market. So, how to manage that, again, options and the cost structure you threw out there, the magic numbers. I think that's a great tool to look at. We did see a few changes, just to note, probably highlighting some of the oil export pace we've seen. We saw an uptick in the oil, increase in the soybean oil export picture. They increased our crush just a little bit. So now we've got a little bit more oil, a little bit more meal production. Obviously, competition out of South America, when you talk about the crush environment, as margins have improved, feels a little bit friendly right now, but that's probably where that supply out of South America comes into play a little bit bigger. They're going to be fighting for some of those meal, some of those oil exports. So from a basis standpoint, I think for producers, I just wanted to highlight some of the ranges. We're seeing a new crop P&W bid, and this may not mean a lot to the listeners, but a 90 under or 90 over new crop October bean bid. There's just no confidence in the market on what our new crop export picture could look like, so nobody's putting positions on. That's we see bean basis on the P&W when we get a pull on exports up in the 150, 160, 170 range. So it's cheap. And that could shift significantly. So, talking about how a producer markets their grain, I'm not sure there's any real favorable basis advantages that you could sell today for new crops. I think having some targets in, using options is probably the best approach here to get rolling on your new crop positions. Brian, on the wheat picture, what do we see?
Some changes in the Black Sea this month for old crop. Notably, I think this month, Nate, we had Russia down another 1 million tons on their export forecast. We're seeing more of the impact of that February 15th quota in terms of a slowdown in their old crop sales and old crop exports as this crop year winds down. The fly in that ointment, though, in terms of a bullish scenario, Nate, is that Russia's got good rain recently. Now, it's not completely over across the entire country, but meteorologists are indicating that the majority of the wheat, beg your pardon, is no longer in drought situation in Russia. So if Russia at some point moving into May and June and July obviously gets comfortable with their new crop supply, look for them to return as an exporter.
Sure.
I certainly wouldn't look for them to continue this export quota if they're looking at a 85, 90 million ton crop for 25. But that's down the road. For the near term, Ukraine exports are increased this month. So they kind of offset each other a little bit, Nate. Ukraine is up 500,000 tons, Russia down 1 million tons. Some other tweaking here and there. EU is down a bit. Canada was up a bit. But the bottom line is we are still the residual supplier of wheat to the world here in the U.S., Nate. And I would say that's going to happen all the way through early summer, pending what happens in the Black Sea. For the moment, Southern Hemisphere supplies, Australia and Argentina, well positioned.
Yeah,
around
good
the world
production.
market. Good production, best competitive price. I think the U.S. is now looking at the supply side, Nate, and I think we're looking at kind of a mixed bag. Tons of rain, needless to say. Viewers will know Southern Illinois, the Delta, way too much rain in some cases. Whereas we're still looking at about 40% of the hard red winter crop out west, Nate, is in drought. Southern Kansas, far western Oklahoma, northeast part of Texas Panhandle, those are pretty, on the drought monitor today, they were pretty dark. So I'd say we don't want to kill the wheat crop here on April 10th, but it's getting more intense for those regions. So maybe a little bit of differences amongst classes. Obviously, the spring or the soft red winter crop, plenty of moisture anywhere you go. Whereas that's the hard red crop, that's not necessarily true. Bottom line, though, wheat is choppy is the best way to say it. There's really nothing to propel it higher. There's nothing really to pressure it lower from these levels. But the one thing we did talk about earlier, Nate, that's worth reminding the viewer about, that wheat corn spread continues to come in. It's nearing those levels, if not surpassing those levels we saw back in the winter, back in January. So that means for the summer, we could see some of that wheat, particularly if the soft wheat crop can get through this wetness here and bring home a big crop. Southeast could be feeding more wheat this summer, and that could hurt old crop, but that's way down the road. We don't want to get too far ahead of ourselves, but something to keep in mind.
And as we've noted and said, it might be needed, right? If this corn balance sheet does come out with a sub 1.5 carry out, we probably do need to feed a little wheat, and arguably some of the rain or impacts on some off-grade feed quality wheat might allow that to flow a little bit easier. So, something to be aware of as again, I feel like there's a little bit of a bullish momentum. If I put my producer hat on, seeing some positives here, getting into the spring planting window, realized if that acre upside on the corn side is realized, obviously we could have a comfortable new crop balance sheet. So you got to be a little cautious on that, but try to take advantage of that volatility. Options. That's what we'll keep talking about.
Yeah, absolutely.
So kind of just a summary here from your perspective, Jeremy, and looking at where we're at on break evens, some of the tariff impacts, we've seen some input costs go up a little bit. There's still some pockets of decisions being made there. We've had some river logistics, some issues getting some of the product I've heard from customers. But as we shift to the profitability for new crop, where are we at kind of as we've seen the board rally a little bit? Is it sit on your hand time for new crop corn? I know you noted some of the old crop options, but what's your approach today on the new crop balance sheet on how you want to market that as a producer?
According to Farm Doc in the University of Illinois website, the break-even price for corn with this year's inputs on highly productive ground is $4.60. The board right now for December of 25 is just a few ticks below that, probably $4.55. So we are inching up there. Obviously, having the basis component as well. So we're below break evens, but we're getting much closer. with everything going on in the world, the potential for a tremendous number of acres, the tariffs, I don't think we can afford to wait for us to get profitable before we get out there and do something to lock us in.
Right.
A small loss is far better than a big loss.
Yeah.
And with this administration, as we saw in the equity markets, yesterday, one announcement led to a 3,000 point gain on the Dow Jones Industrial. One announcement could make or break corn or beans. You need to run to your advisor and tell him you want to get some puts to protect this new crop. This announcement could come before this is over. It could come a few weeks from now, and who knows what kind of a trade deal we're going to have and how it's going to affect this market. So get out there, let's get protected. The risk is too great not to. I already discussed beans. I like the short dated $10 July.
It's a good window to get you through U.S. planting.
29.
Maybe see some of the continued back and forth on the tariffs. I really like that value for that.
And on the corn, short dated 450 is at 14 cents. That's not a lot of money compared to what you could lose. A full December is right at 30 from the 450. As much news as it's coming out before those expire in the end of June, I think I'd stick with the short dated myself. But there's nothing wrong with going to the full dated. And again, if you're watching this live, as soon as you hang up or click it off, call your advisor and let's get these on, because this market could move quickly any moment, any day.
Yeah, the short dated comment still kind of resonates with me from a perspective of what we just saw in the ending stocks and kind of the, hindsight here, the combination of some of these reports. We saw a huge acre number, not a big reaction in the market, right? There's a lot of positioning going on in this market. And so this arguably, a fairly bullish ending stocks for old crop, and the market's not, we're not running higher, firmer, maybe some continued strength in this market. But I think the overtone of the tariffs and the unknowns there continues to play into it. And on the corn specifically, the headwinds of that new crop balance sheet. I mean, you hit it, Brian. I would be surprised, barring any major weather issue, for corn acres to significantly come in, reduced to create. We got to get a yield. It's numbers on paper. Obviously, we could see adjustments with that, but the market's going to react to planting pace, and a 95+ million acre indication and planting pace picking up. I struggle to see that as a bullish new crop scenario. I'm not saying sell everything today, but the option side of that, give you that protection through the planting window. If we get 96 million acres in, you're going to be glad you had that option on that short dated position. And then you can make some decisions going forward. Or, if there's more optimism of trade agreement, that includes corn, right? That was a big bump in that 2020.
It was.
Kind of, we focused so much on the beans, but that was a big year for China's corn. Their production looks ample. Their demand has obviously been down this year. We've seen the USDA reduce their import total. Now it's at 8 million metric tons, unchanged today, but that started this marketing year at 17, 18, somewhere in the upper teens. And obviously their pace of buying has been down. If we're stable on a South American production, potentially even down a little bit year over year, their domestic use up. Our old crop export picture is what's positive today. That can shift very quickly with an ample supply and a 2 billion bushel carryout for new crop. Got to prove all that, but to sit back and just hope for that, I think it's, every year that's a risk, but it feels like a heightened risk this year, just given the unknowns in the political environment.
Well said.
Well, appreciate everybody joining us. Any last comments from you guys, or we hit it pretty?
Just wish everybody a safe planting season here, and hopefully we can dry out and get these crops in the ground.
Absolutely. Appreciate the time, everyone. Join us next time for May 12th, next USDA report. ATI Pro Media every morning. Appreciate the time.